what's made you successful?
Well, and thanks for inviting me, Simon. Well, investing is all about risk and return, and the vast majority of investors focus on return. That's what you see in any asset allocator. What's your returns? Yeah, that's the only thing. But I focused actually in my career on risk firstly. Return does matter, but to me, risk was always the first thing that mattered. And a lot of people have their own definitions of risk. I love George Soros's definition, which was not knowing what you're doing. So what does that mean? For me, that's understanding what matters in investing. And there was a spiritual master once, he said, very few things matter and most things don't matter at all. And that could also apply to investing. So what does matter? Competition matters, because too much competition erodes your profits and maybe you don't make any money at all. So I hate competition, and makes predictability and valuation impossible. And the interesting thing, so to me, in a sense, competition and disruption are the whole thing. It's not about growth, because you can have a first mover advantage, grow for a period, and then a new technology or a new competitor kills you off. And the fact of the matter is that most investors underestimate the forces of competition and disruption, because they underestimate complexity, they look short term, and so we do two things really. We're looking for such companies and with such high barriers to entry over the long term that we think we can have a reasonable idea that they'll be around. Okay, can't be precise about exactly what they'll be worth, but they'll be there not in 1, 2, or 3 years, which is the normal time horizon of an investor, but in 20 or 30 years, which is the time horizon where the value, if you do an MPV model, really is. And so we try to focus all our time on barriers to entry and disruption, and and the second component of the philosophy, if you like, is long-termism. Now that's fundamental. Our average holding period of a stock in our portfolio is 8 years. We've held stocks for 13 years, and 12 and 10, but the average is 8 years, which is like starting to get into private equity land of duration of investment, and it's counting, 8 years and counting. Now, you may, but it's an interesting question. A lot of people make money with high frequency trading. The shorter the trading horizon, the better. The average stock holding period is under a year of a stock in the US. So it's all very well to say you're long term, but that's only a good thing. It's not necessarily a good thing unless it works. And it only works if you're right on the first point about the quality of the company and the barriers to entry. But if you're right, that you find a company that is going to be a good company long term, then you should hold on to it, because there's a persistency of these barriers to entry and the things that make it good. So in simple terms, good companies stay good and bad companies stay bad. But and I guess there's another point. There aren't that many great companies, the super companies of the world, and if you find them, you should hold on to them. So that's and then there's related concepts like engagement and concentration, but those are secondary to the first points.
So let me ask you about those barriers to entry, because how has your thinking in identifying them changed in the last 2 decades?
We've enlarged the universe over time of things that we have found that are more companies, more industries, as we've learned. Like everyone, we're always learning. If you so I always liked hard assets, infrastructure. But what came within that, could expand beyond. We've owned a lot of airports and toll roads, but we found toll roads in Europe, then we found toll roads in Canada and the US through Ferrovial, and cell phone towers, and railroads, and but then beyond hard assets, infrastructure, we found other barriers to entry, such as network effects. Okay, and there's certain industries. Payments is one. We've been a shareholder of Visa a long time, where it there's this huge, ever-growing network connecting every customer and every bank to the world, and as the network grows, it becomes just ever harder to replicate. Aerospace is a sector that we've come to learn about and understand, and where the barriers to entry are multiple. Often you would like not just one barrier to entry, but maybe 5. Intellectual property, you could have maybe it's brands, hard assets, contracts, network effects. We're big shareholders in aircraft engines, where you have many of those IP, contracts. Installed base is another barrier to entry, where customers can't switch, regulatory switching costs, so we've expanded. Rating agencies is another one. So and one of the key sort of points of if you really do find one of these super companies that can dominate their industries, they have something special, which is pricing power, which is a rare thing. So most companies don't like to talk about it, and it's a special thing because it means you can grow more than your volume, and it's got a leveraged effect, because if it's above inflation, so pricing power means you can price above inflation, then there's no cost to that. And if you have a 10% margin, it might give a huge, every 1 point of real pricing power is massive. it's just super leveraged and potent, and so but I think the world is changing so much that some of these apparent moats are being just beaten down by AI and other disruption forces. So the forces of disruption, I would say, are actually rising.
So that was what I wanted to get to. Disruption is around us. You got access to all sorts of very clever people, great conversations. But how do you think about identifying those underlying weaknesses that may derail the thesis?
Well, you really want something that's obvious. Warren Buffett used to talk about this. If you can't put it on, and when it's not obvious, you probably just leave it alone because it's probably not sustainable. So it's sustainable barriers to entry. So if we own an airport, it's pretty obvious. We own a company that owns all the airports in Spain. We've owned it for a decade. I was on the board. No one's ever going to rebuild those and overbuild you, and 75% is unregulated. So when you look at it, the shops and so the infrastructure piece is, especially if you get it unregulated, toll roads where you have a 100-year duration or 60 years, like Ferrovial, those are, people. We don't know whether people are going to drive electric cars or which brand of electric car, but it's pretty clear they're going to need these roads, and so those are obvious things. I'd say when you have multiple of these barriers to entry, no alternative option. So we like aircraft engines, but will there be an alternative technology? Will they become electric? The science doesn't really permit that, and it's too expensive to replace the existing fleet. So you've probably got a pretty good visibility on 25 years, and so we think technologies that change quickly aren't good for us. Can't predict them. So I would say some principles would be multiple barriers to entry, and and essential need. Something that is essential. So you've got to be confident of the need. So are people still going to want to fly? We believe that's a durable need. So we don't like discretionary things. I've never been an investor in the handbag business. Right. Lots of people have, and they've made lots of money in it, but I've never, understood what makes one handbag better than another. Or why it's essential. So anyway, it may well be. I don't need to understand everything. Just stay within your sphere of competence. That's what Buffett said.
But we have this. What is fabulous about the investing business is it's the quantitative meets the qualitative, and you've written a lot about engaging with management. And I wonder, when you go to meet managements today, you've done this for a long time. What are you thinking about that conversation?
People read about us and they say, "Oh, you're an activist." Well, we've done that. It's sort of a tool, but we prefer always to have constructive, long-term relationships with management, and we hold an investor day in New York every year for our investors, and this year we had the CEO of Aerospace, the CEO of Airbus, came to speak to our investors on the stage at the same time. Never been done before. CEO of Moody's, CEO of Vinci, top executive from Visa. So and every year we have the same thing. And these people come because they think we can add value to them. Our Aerospace analyst was invited by GE's CEO then to speak to their top 300 managers about the company. So that's not normal. Why do they do that? Because they think we understand the company and we can add sometimes some value. They find it a value-added conversation. So because we do so much research on a company that, and we follow the industry, so we want to be, we want it to be a relationship, okay, and that means and it to be a conversation. Now, of course, we weren't always like that, but we've evolved, and so I'd say it's really is engagement. Through engagement, you can learn something. If it's a one-way conversation, you're just speaking at someone, you don't learn anything, and we have to learn.
But along your way, there will have been some investments that didn't work as well. And I wonder, when you reflected on those, was there something in those conversations that maybe you weren't as sensitive to that maybe you are today?
Well, ultimately, the quality of the business trumps everything. And so I'd say does management matter? Somewhat. Yep. It's not the key thing. And a great manager in a bad business, they can't really necessarily do much. And so I think focusing on trying to assess management through conversation may miss the point. Okay? So I think you may overstate the value of the management and sometimes management won't even necessarily understand their own pricing power and latent pricing power, So, but I don't think I think it's, if I would say something on the question, you've got to listen and see if you can learn and be humble. If you become arrogant, that's a killer in the investing business. Yeah, I've had.
I'm trying not to say anything.
Yeah.
Given that there are stretched valuations in all sorts of parts of the world, you have been very comfortable shorting in the past. Sort of under what circumstances might you have more shorts than you've had of late?
I've never really been a significant short seller. I don't think I've cumulatively made absolute money in it, and I sort of agree with what Warren Buffett told me one night. I had a dinner with him and I asked him about shorting, and he said he didn't do it because he and Charlie Munger concluded it was just too hard, too unpredictable. He thought long and hard about it, because in shorting you need to also understand investor psychology, because when the short goes against you, you have to fund the losses. People think that's like a costless thing, but you have to sell longs to fund the losses on shorts. And you can eventually be right, but can you hold your position? We did have a short a couple of years ago in Wirecard, where we thought it was a fraud, which is, we have a very high bar on, and actually apropos timing, I filed a public criminal complaint against the company in the Munich prosecutor's office. Because the company wasn't too happy. The chairman used to be the CFO of Deutsche Börse. He said I was a liar, but within 2 weeks it was bankrupt. Now, and then the media got involved, and they went to Australia to meet a guy at Bronte Capital, who was one of the very first short sellers of Wirecard 20 years ago. And the journalist said, "Congratulations. Yeah, it must be a big day for you." Yeah, but the stock had gone up 20x, and he said, I had to cover it after a year. I couldn't fund the losses. Yeah, so I wasn't here to see the day it went bankrupt. Yeah, I lost. So it's a very hard thing, and you can be squeezed if you watch the movie Dumb Money. It's a great movie. You'll see the difficulties of short selling, of being short squeezed. So there's so many technical issues that sometimes you just have to, experience tells you, it's just too unpredictable. And because of the investor psychology point, yeah.
So it's interesting. I see in the front row is Chris Dale of Kintbury Capital, who also successfully shorted Wirecard for a while, and well, right to the end actually, as it happens. And I'm an investor with them, which is why I know. What are you most excited about when you think about the investing landscape?
I like things that will just compound long term. I don't change year to year very much, so I things that I feel confident will be around in 30 years in a dominant position excite me because it's just predictable. I value predictability. Yeah, it's sometimes people, your very question illustrates what most investors are looking for: the next hot thing. Yeah, the new thing, and sometimes I'll say, a little bit sarcastically, "Well, you want to investors say, what's new?" I say, "Do you need to change your wife every year?" Yeah, it can be a difficult conversation. Bronwyn always says, "Don't ask that question," because people might give them ideas. So,
what do you know, by the way, that I don't?
Yeah, yes, well, you wouldn't ask that question because you're happy with it. Yeah, you're happy with what you've got. Yeah, and it's it's not that easy to find. There's some truth in some of these funny examples. It's not that easy to find the right partner. It's not that easy to find the right investment. So why do you want to change them immediately? If you find something good, it's going to be good long term, stick with it, and don't think that newer is always better. This is what investors think. They don't think about sustainability. They want the next hot thing. They think growth is the thing, but new is the thing. But that, we want to be, because so many people think in terms of what John Keynes or actually Benjamin Franklin, not Benjamin Franklin, but Benjamin Graham said that in the short term, the market is a voting machine. What's hot? Yep, it's new. But in the long term, it's a weighing machine. Yep. So in the COVID, Peloton was hot. Yeah. Went to $50 billion valuation. Everyone was on their Peloton machine, but then, virtually went to zero. And so, yeah, I think that's the most important question is just, we're more interested in the question, what's going to be around rather than what's new.